Well, President Trump believes the use of tariffs will ultimately be to the benefit of the country. Even he has said that the policies may initially cause some pains. The most widely cited of those pains is inflation, and we'll discuss that more later. But before we do, I want to touch on another aspect that is already having an impact on financial markets. That's the heightened level of uncertainty caused by the tariffs. Uncertainty is a natural feature of investing, but as this graph shows, the level of policy uncertainty today, largely due to what is being proposed on the tariff front, is at levels only surpassed during the height of the COVID pandemic. There are at least two kinds of uncertainty around the tariff policies. There is the uncertainty about the tariffs themselves, which tariffs will actually come to pass, and how long they will last. Then there's the uncertainty about the economic impacts of the tariffs. It's the former that is already impacting financial markets. Conversations between the US and various trading partners is happening behind the scenes, but a lot of the posturing about which goods will be subject to tariffs, at what rate, and for how long is playing out in the media. The information is coming fast and furious and is changing frequently, which only serves to put investors and markets more on edge. In addition to simply weighing on the nerves of investors though, there is also a very real-world economic cost to all the uncertainty. That uncertainty is already leading businesses to delay hiring new workers or pushing forward with new projects. So despite the fact that tariffs for most countries were announced in just the last few days, that doesn't mean we aren't already feeling some of the impacts in financial markets. US equities, for example, got off to a good start to the year, but then peaked in mid-February and declined by more than 10% from those highs. As I mentioned previously though, the biggest pushback on tariffs centers on their potential inflationary effects. The new Treasury Secretary, Scott Bessent, acknowledged that the tariffs would cause a one-time price adjustment. After the last few years, it shouldn't come as any surprise that Americans are nervous about policies that might be viewed as inflationary. We're certainly not going to dismiss those concerns, but we also want to keep things in perspective. This is a chart from Goldman Sachs that was produced before the April 2nd tariff announcements showing their projections for inflation under various scenarios. While the no tariffs line, the black dotted one, shows inflation falling to about 2% by the end of the year, the light blue line, which is their recently updated baseline forecast that attempts to incorporate the tariff proposals, peaks at around 3% before falling back towards 2%. Even the dotted green line, which aims to take a more pessimistic view on tariffs and their broader impact, peaks in the low 3% range before also falling. Yes, those figures would indicate higher levels of inflation, and that would be unwelcome. But the levels are also a far cry from what we experienced a few years ago when inflation spiked to over 9%. I'll add that in addition to raising their baseline forecast for inflation levels, Goldman in the same report lowered their economic growth figures for the year from 2.2% to 1.7%. That's obviously also a negative change, but it's far from projecting a recession and aligns closely with the Fed's current projections as well. As I mentioned previously, the administration acknowledges that the tariff policies could cause some short-term pain, but also expressed confidence that the short-term pain will bring long-term success. While the April 2nd announcements provide some guidance for modeling how this might impact the economy and inflation, we need to keep in mind that those initial policies are likely to change. In some cases, we could see a de-escalation of trade tensions after some negotiating, while in others, it's possible we'll see an escalation via retaliatory tariffs. The one thing that does appear clear at this point is that we shouldn't expect a quick resolution. Opinions and projections from economists are going to differ, but we take some comfort in that by most estimations, at least the ones we've seen, the revisions to inflation and growth look similar to the Goldman projections in that they directionally point to higher inflation and slower growth. But they are also generally moderate in nature and not as extreme as perhaps some of the media prognostications might suggest. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this segment.